Hello traders, Corey Mitchell here with TradeThatSwing.com, and in this video we're going to look at a guide to shorting. Get asked about shorting quite a bit, what it is, how it works, when to use it, look at a couple strategies of its risk rewards. We'll also look at the difference between what is shorting in stocks versus shorting in, let's say, futures or Forex or options. Shorting is sometimes used in those contexts, but it means a little bit different thing. So first, let's look at what is shorting. When is it used? So I like to think of shorting as, a lot of people think of trading as like buy low, sell high. That can be flipped around. You could sell high and buy low, or sell low, buy lower, right? So shorting is selling then buying as opposed to buying then selling. With trading, we can flip those around if we want. The order, as we'll discuss, doesn't really matter. So a short position profits if the price drops after taking the short position. It loses money if the price rises. So we'll look at a couple examples of how that works. If someone believes an asset price could fall, you could profit from that by shorting. So shorting, as we discussed, is associated with stocks, but the term is also sometimes used in Forex options, futures. We'll talk about how the situation varies a little bit. Shorting a stock means you sell it without owning it. So that's where a lot of the confusion comes in. How do you sell something you don't own? Well, first, let's talk about the dynamics that go into it. So you receive funds for selling, but they're not yours yet. Remember, I said you can sell first, then buy, or you can buy, then sell. So if you sell something, you receive some money. So let's say you shorted 100 shares of a $10 stock. You think it's going down. You're going to receive $1,000. That money's not really yours yet, right? You haven't closed out that position. Your profit or loss is based on when you cover that position, when you close that position. 100 shares, let's say the price does drop and you close that position at $9. You have to buy at $9. So you're buying 100 shares at $9. That's going to cost you $900. You initially received $1,000. So your profit is $100. Let's say the price goes up instead of going down. And now you don't like the trade anymore, you're losing money, you decide to exit at $12. You have to buy, you're buying 100 shares at $12. It's going to cost you $1,200. You only received $1,000 initially, so the difference is you're down $200. You bought it for $1,200, you sold it for $1,000. Now, some people might think, well, why would I sell it at a loss? Well, there are some reasons. Just like a loss, just like a long position, when you buy a stock, your profit's always fluctuating. So it may come to a point where you can't handle the loss anymore. You don't want to lose that amount of money, or we set a risk limit on the trade. We thought it was going to go down, and we say, okay, well, if it doesn't and it goes up, I'm going to get out, and that's my loss. So there's also the issue of a short position. Our risk is theoretically unlimited. Now, I've never seen a stock go to infinity, but you could lose a lot more than you have in your account, and maybe even your entire net worth. And I've seen examples of it happen. I remember this was a number of years ago. A trader was short just on his like home E-Trade account or whatever, was short a pharmaceutical company, and the guy who took it over said he was going to skyrocket the price of the drug. The stock skyrocketed the next day. It gapped up. There was no chance to get out. And the next day it opens, he shorted it, I can't remember what the numbers were, like $10, and it opened at like 100 or something like that. So let's say he had shorted $1,000 worth of currency, or 10,000, and then he owes 10 times that amount the next day. So you received $1,000 on your short, but the next day you owe 10,000 to buy it back. And I remember it was a fairly big amount and he started a GoFundMe page to try to make back his trading loss that he couldn't pay. It was a big situation. It can happen. So be aware of that. We'll talk about some situations to maybe to help avoid that situation. But it is theoretically possible to lose more than you think you can on a short position. Because if you go long, the stock can go to zero. So you're going to lose what you put in plus any leverage you had. But it can only go to zero. But if you short a stock, let's go back for a second. You sold this at $10 and received $1,000. If crazy good news comes out overnight and the next day this stock is trading at $30, what do you have to buy back? $30 times 100 shares. You're losing more than you even received for the trade. So a lot more. You're going to be down. You have to buy it back at 3,000. You only received 1,000. You have to pay out 2,000 just to close out that position. Now imagine if these numbers get bigger, you can see why it can really start hurting. Now we can use stop losses. We can still manage our risk, but it's important to be aware of that short positions do carry a risk that you could lose more than 100% of your sort of invested capital, or how much that short position, right? If we go short, it can only go to zero, right? If you short at $10, it can only go to zero. You're capped at how much you can make, whereas it can go up infinite amount technically, and you could end up paying that price. Now you can always get out along the way, hopefully, but if there is that gap, that situation where the price gaps up overnight, you could be paying a much higher price than you expect. So things that happen where that occurs, the big ones are like a buyout. A company just gets bought out by another company, and that's going to happen generally overnight. A company is going to come out and say, hey, we had an offer from this bigger company. They're going to buy us. We were trading at $10 a share yesterday. They're willing to buy us for $20. What do you think happens? The next day the stock's going to be trading at $19 or something like that. So instantly, overnight, you lost $9 a share, times however many shares you had. So that's a risk. But going long is also a risk. You can have bad news come out. A company can say, hey, our accounting is a mess, or our CEO was embezzling funds or something, and the stock takes a huge dive overnight. For short positions, this goes back to that, someone saying, I always get that question like, well, we go back to this example. It's like, well, I'm not going to close out my position when I'm losing money. Well, with shorts, you have to borrow the shares in order to sell them. So this is getting to, how does shorting actually work? How can you sell something you don't own? So let's say I own shares of NVIDIA. You want to short NVIDIA. Now, we're not going to actually talk to each other and say, hey, well, I'll borrow you my shares and you can sell them, but our broker has all these people who are long shares, and I can say, yeah, I'm willing to lend out my shares. I have no plans on selling them. So someone else can sell them as long as they buy them back. So my position in NVIDIA stays intact, but you can short owning, basically because I own them, you can sell my shares. There's a fee for doing this. I'll get paid a percentage for lending you my short shares, or at least some brokers feed that back to the person who's borrowing out their shares. Why do they do this? Because you could theoretically, let's make the example very simple. Let's say there's only 10 shares of a company outstanding. If you could just short without borrowing, you could just short the stock into the ground, right? Because there's no cap on how much people can short. It's like, oh, I'm willing to short 50 shares, right? Just keep shorting and push the price down in your favor. When you have to borrow shares, that means you can only short as much as people are willing to borrow you, or the kind of amount of stocks that are outstanding. It limits how many people can short. So it's a safeguard in the market to prevent basically over shorting, where you only have so many shares outstanding and you actually have more shares that are short pushing the price down than the company actually even has shares. So that's the safeguard. And how things differ a little bit from other markets, because this is a little more exclusive to stocks, this process, because it's a safeguard. But that's basically the process of how shorting works. If you short, you're theoretically borrowing someone's shares that owns them, and you're going to pay them a little percentage fee. You'll usually see, like, if it's a really heavily shorted stock, you might be paying 50% a year, 100% a year, 10% a year to be short that stock. That also puts a bit of a timeline on your trade, where you want to be making money on that position. And if you're not, it's like, okay, you're losing money on that position. It went up. You thought it was going to go down. Plus, you're also paying interest. If it's not a heavily shorted stock, then you might be only paying 1, 2, 3% a year kind of thing. So maybe not. It's an issue in some cases, because stocks that are, if everyone wants to be short a stock because it's just plunging and they think they can make money, what do you think is going to happen to the fee for borrowing that? It's going to go up, right? Because it's basically supply and demand. There's only so many shares that can be shorted, and the people who are willing to hold, they're going to want a high fee for giving them to you to say, hey, you can short this, but you're going to pay a high fee for it. So just as there are strategies, one would be use shorting, and we'll look at some strategies in a bit. There are strategies for buying stocks on the rise, and there are strategies for shorting stocks on declines. Many long strategies can be just basically flipped upside down. If you like trading rounded bottom patterns, well, start looking for rounded top patterns, and you can see stocks that are starting to roll over to the downside. When do we want to be a little bit careful? So that situation I just talked about, if everyone wants to be short a stock, and you can look on financial websites such as Yahoo Finance, FinViz, lots of them will have basically like a short percentage or a short ratio. If that gets high, like if you're talking 30%, 40% short, that means like of the shares outstanding, 30 or 40% of them are being shorted. That's really high. Even like 20% is pretty high. If you look at really solid companies, they're going to be like 3, 4, 5%. Like not many people shorting them. So if a stock's really tanking or people really think it's in financial distress, it's going to be highly shorted. Now you think, well, it's dropping, everyone thinks it's going down, that's got to be a good thing. And it can be, because it probably is dropping if a lot of people want to be short. But that also makes it prone to a short squeeze. We already talked about there's that element of you are paying a fee to be short plus. So that kind of puts you on a bit of a time frame. You don't want to be holding that trade longer than you have to and paying the fee. There's also, it's basically interest. There's also the issue of if that price starts rising against you, now you may be willing to hold, but other people may start scrambling out. If you're short, what do you have to do to get out of the position? You have to buy, which pushes the price up. So now you have a bunch of people who are short trying to push the price down or thinking the price is going to go down. But the price starts edging up. they get scared. What do they have to do? They have to buy, which pushes the price up higher. They have to buy, pushes the price up higher. And then the higher it goes, the more of a domino effect it has. The more people you have short, the more they have to scramble to get out quickly. So it can result in these super fast spikes. If you want examples of short squeeze, look at GameStop over the last, go back several years, and just look at these massive spikes on that chart. You'll see what a short squeeze looks like. That was a little bit of a coordinated short squeeze, but nonetheless a good example of what could happen if you are short. And again, I'm not saying shorting is bad. I'm just saying be aware of the risk. I do take short positions. Nothing bad has happened. You just are aware of your risk, and I'm more prone to take a loss quickly as opposed to holding on to it because, yeah, things start escalating against you and you're in one of these highly shorted stocks, you know that it can pop against you quite quickly. Another situation you want to be aware of, this goes for long or shorts, is around earnings. So when a company issues earnings, that's a pre-planned, generally volatile event. If the news is positive, that stock's going to gap up, which leaves you in a position where you may not be able to get out of your position until the stock opens the next day, or maybe you can get out in the pre-market or post-market, but still you could face a big loss. If it's a really good news announcement, you short it at $10, boom, the stock's like instantly at 15. You just lost $5 a share, 50%. That's a lot, right? So just to be aware of that, I avoid holding short-term trades, long or short, through earnings, just because generally with a short-term trade, we're going for, kind of this much profit, and a gap can blow that out of the water. And long-term positions, if you're an investor and you're holding for, many months or years, then holding through earnings may be part of your strategy, right? If a company is doing really well, you want to be in for those earnings announcements because generally they're positive. Generally they're coming out with good news. But when we're short, just be aware that this is one of those events that can cause a gap, which can cause you not to be able to get out, and you could be getting out at a much worse price than expected. Shorting is not required. It is an add-in. And I think that's why people start asking about it, is because maybe they've been trading stocks for a while and they think, well, what's this about shorting? Maybe I can make some money when something drops. It's not required, but it is a good option to know. I would say it's very optional for swing traders. Not required at all. You can just wait for the long opportunities. It is highly useful for day traders, I would say. Not, again, required, but very highly useful, because even in a stock that's like in a super big uptrend on a longer term chart, or even intraday, it's generally going to have big sell-offs the other way, like during the day. So you might have this big up move of 10%, but it's also probably going to have a drop of, even if it stays up on the day, it's probably going to sell off some of that. You're going to have a drop of 5%, or, there might be a very steady downtrend at some point throughout the day, which we could capitalize on. So it's not required, but I would say it's very useful. I would say for day traders, it is useful to be as comfortable on the long side as it is to be on the short side. I flip back and forth all the time. Day trading, I would say, is less risky to be shorting simply because we're not holding overnight. We're generally not going to be involved for those earnings events, crazy news that comes overnight. We still want to be aware of news events that are scheduled during the day. If you are short heading into an Federal Reserve interest rate announcement, that might be dumb. Even being long going into an interest rate decision might be dumb for a day trader, because you're going to get, it's going to be quiet coming in, and then you're going to get this massive move when the news comes out. Just step aside, get out of the trades before the news, then step back in and trade after the news. So I just threw a couple swing trading examples of, so one's kind of a price action, one's more of a, the other one's a price action too, but more of a trend channel type trade. Day trading, I didn't include any of those examples, but there's lots on the website if you go to tradethatswing.com under the stocks or Forex trades and analysis. But here, I just wanted to go through a couple examples. So I prefer trading if I'm going to go short, I don't want to trade something that's super strong and I'm trying to anticipate when it's going to fall. I'd rather trade something that's already in a downtrend, and I'm going to trade it after it's had a really nice, hard sell-off. And so I thought this was a good example because it might look the same, but it's not. So I put it kind of like a face on this one. I don't like this one. This looks really good. Like we have a really sharp drop, and a little bit of my strategies. I'll wait for the pullback, and then once we start making lower candle closes on that pullback, I'll short. So the short position, if I would have taken this one, we had this green candle, and then once that pullback starts, if we drop below a candle, I'm going to short. So we would have got in right at the top of this red candle, or basically the low of this green candle. So we dropped and had a pullback, but I put a not so good face on it because while it's a nice sharp drop, it doesn't really make any progress below this last swing low. It just kind of gets there and then has a bounce right away. I don't like that. That's not quite enough momentum. I like this one a bit better because look, like we have all the momentum, and the last swing low was here, and we just plowed through it. There was a little pause there, but then boom, we took it out. Like, the sellers are coming in hard. So then what's the strategy? Price is popping. We're waiting for the price to drop below a low. So the entry would have been right here. Stop loss goes above, and we get a nice run to the downside. This is a pretty volatile stock. You can see it went from up here around 170 down to 64. This might not be the introduction shorting trade. So we also have one. Trend channels tend to be a little bit more rhythmic. This one also, these stop losses are about, at the entry price, the stop loss is maybe like 3% above, and we're kind of going for 6-7%. But that is a 3-to-1 reward to risk. That's pretty good. So just a different type of stock, a slower moving one. We can still see a clearly defined downtrend. I have an article on channels on tradethatswing.com if you just type in channels in the search box. And I draw them a little different. I don't draw them along exact highs and lows. I want to include as many highs and lows as I can. So I draw what I call a line of best fit. And then once the price gets there, I'm kind of waiting for either like consolidation and then the price drops out of it. So if it had a nice little consolidation up here and then the price dropped out of it, I'd go short. Or in this case, we have a little rounded top. Like prices goes here, pull back, slightly higher high, drops, makes a slightly lower low. We have a pullback. And then I'm using that same kind of entry technique. Once we have that pullback, once the price drops below the last candle, I'm going to go short. Target kind of goes near the bottom of the channel at the time I take the trade. The more aggressive one would be to continually move that target along the bottom of the channel as the price progresses. The problem with that is that basically it's always moving down because this channel goes down right to zero. So somewhere in between there, I think that this is the most basic one. When you take the trade, put your target at the bottom of the channel. And then if the price progresses, it gets into a bit of a range here, you want to move it down a little bit toward the middle of the channel. Okay, great. Or maybe toward the bottom of the channel. That's okay. But yeah, very basic. That's kind of the basic idea. We wait for a bit of a topping near the top of the channel and sell off. This one, we get that big consolidation I was talking about, really chopping around. So we could take it right on the breakout. I kind of like this one where it dropped a little bit, then we got a bit of a pullback, and then take it when it starts dropping again. But here would have also been okay right at as it started really breaking out, and then the stop loss would have gone above the high. And again, target, when we take the trade, target goes at the bottom. So you can see target ends up on here, target ends up here, both were exceeded. We talked about earnings. You can see none of these trades affected by earnings. We were out before earnings. This one, we took it after earnings, multiple, maybe a month or so after. This one also about a month or so after earnings. And yeah, we're out before. If we were still in this trade, I would want to be out of it before earnings. Let's see if I can move my hand there. So Forex, futures, and shorting. So people will sometimes say they're short a Forex pair. That's fine. But we're not really shorting in the same way that we'd be shorting in stocks. Because you're basically just kind of swapping currency. If you buy the Euro USD, you bought the Euro and sold the US dollar. If you sold the Euro, which would be referred to as a short, because that's like a commonly traded pair, the Euro US dollar, in that order, Euro US dollar, then you might say, yeah, I'm short the Euro US dollar. But you just bought the US dollar and you sold the Euro. Right? You're basically, whatever the first one is, that's the one you're buying. So if you bought the Euro, you're buying Euro. If you sold Euro USD, you sold Euro, and you bought the second one. You aren't really selling something you don't own. You're converting what you do have to make the trade. So even if your account is in Australian dollars, you are converting that money to then buy euros. So you're not really selling something you don't own. Yeah, it's a little different than stocks. Now, futures, we do have short positions, but if you take a short position, I like to think of it as, think of yourself as someone who has actually used the futures market for business. We'll talk about speculators in just a second. So a sell to open is referred to as a short position, but they're not really short. We think of them as short, and a sell to open means you sold first. So you sell a futures contract without owning it. But I want you to think of a commodity for a second. Let's think of wheat contracts, wheat futures. Think of yourself as a bread company. If you buy a wheat contract, you're saying, I want to buy this set amount of wheat. I'm willing to pay this price, and you're going to give it to me on this date when the contract expires. That's the role of the futures market, so that you can buy a commodity at the price you buy it at, and you'll get delivery at a set date. If you sell a wheat contract, now you're selling it to the bread company. You're the farmer. You're the one who has the wheat. So we think of them as short, but they're not really short. They just have wheat to sell. They're just selling their wheat. And basically the futures contract is their way to sell their wheat at a price that they decide to sell it at. And when the contract expires, they can deliver their wheat. So a futures contract is an obligation to deliver or take delivery of a good. Now, as speculators, I don't have a whole bunch of wheat behind me or a whole bunch of oil when I trade oil or gold that I'm willing to sell. And I sure don't want a bunch of oil being delivered to me. So I can close out my position before expiry, or I can roll it, which just means my position gets moved to the next expiry date contract. So there's no delivery or no taking of delivery, but again, the shorting is different. The people who are actually selling contracts, they have a product to sell. And as a speculator, we may be short, because we don't have, I don't have any wheat to back me up. If I want to short wheat, I'm doing it purely speculatively, thinking the price is going to drop. I'm going to close out that contract before delivery, but I do not have any wheat to actually sell. So the farmer's not really short. He's just selling. Me as a speculator, yes, I can be more theoretically short. Let's do options last, and then a quick conclusion. So with options, you can buy a call, which is like kind of similar to going long a stock. You're expecting the price to go up. Or you can buy a put, which is expecting the price to go down. But in both cases, you are the buyer. Puts can simulate a short position in a stock, but you are still, whether you buy a put or a call, you are the buyer. So someone has to sell you that contract. They are sometimes the ones that are referred to as short. But more accurately, they're an options writer, or they wrote the options that they gave you. Sometimes referred to as like an option seller as well. So they sold you the option to open up your call or put position. Or you could write a position, you could write an option, and then wait for someone to buy it off of you, a call or a put, and they can buy it off of you. And when you buy a call or a put, your loss is limited to the amount that you paid for that option. So an option price is a premium. You pay that price, and that basically gives you the right to buy or sell that stock at that price up to a certain date or within a certain time. The writer, in some situations, faces infinite loss, kind of like the short stock trader does. The price could keep going up on them, and they would have to cover at a higher and higher price. That can happen with a writer as well. Now, there are ways to block that, though, with options. You could have a covered position, which means you have the position that you're writing a option on, or you could write offsetting options, things like that. So there are some ways to mitigate the damage or the risk with options for option writers. And yeah, but just to be aware, that's how things differ a little bit. So we have the stocks where you have to borrow from someone who owns them. You know, that happens behind the scenes. You never see it. And then we have options, futures, Forex, which are all a little bit different spin on shorting, sometimes referred to as shorting, but that's how the mechanics work in those markets very briefly. So I hope you enjoyed this intro to shorting. Like and subscribe. Check out the other videos. There's weekly stock market outlooks. We have trading psychology videos, trading strategy videos. So, click on the channel, browse through some of them, and visit me at trade.swing.com. Loads of trading tutorials and courses on swing trading, day trading, investing, Forex, stocks. And yeah, hope you enjoyed the video and happy trading.